And welcome back to Beyond the Card, a podcast that brings to you the payments news that you want to hear most. And frankly, we want to talk about. It's episode 6. We have all of our hosts in here today, and we are excited to have some rousing discussions on some of the hot takes of the news that we've seen recently, but then also get into our main session today, which is the Marshall-Durbin Credit Card Competition Act, and really kind of walk through what our thoughts are on that and really what we think is going to happen there. So, welcome back, everybody. I think it's good to have a full house.
Yes, thanks.
Hello, everyone.
Hello.
So let's just jump right into it, and let's start talking about Visa's latest announcement with their digital products. So this is going to be, I think, really interesting. Someone once asked me years ago, with the advent of all of these different payment methods and payment technologies, are Visa and MasterCard still really going to be relevant in 6 years, 10 years time? And I was like, I'm sorry, do you know anything about the card networks? Of course, they're still going to be relevant because they're going to start jumping in and either acquiring companies to keep themselves relevant, or they're just going to evolve. And I think this is really interesting. I think the thing that I find most valuable out of this is the Visa Flexible Credential, which to me really reads as like, if you have a Visa branded card product, you're essentially just going to have one maybe digital token external to you, and then it's just going to be able to swap in and out different payment methods. So instead of having to keep track of 4 cards in a wallet, or, if you're a Chrome reader, right, all of these saved payment methods, you're just going to have one. I don't know. What did everyone else think of this latest blast from Visa?
Personally, I think that it's a great idea because it will avoid a lot of things, especially in merchant side. For instance, having, the difficulty to get the token or something like that, from different providers. So this will probably have an impact on it. Of course, it will require the different providers to be able to manage that. But it could be a good thing at the end.
I think the flexible credential where you can switch between your card types is super cool. Where you just, it's, I guess, similar to like how you have things in your wallet, but I think they're just trying to come up with creative solutions for businesses and knowing kind of where things are going and how people just want easy access to everything. It's just like whenever I go somewhere and tap now, then as soon as you do that at one place, you're looking for it at all the other locations and retailers that you go to. And it's kind of one of those things, as soon as your consumers get used to some type of new technology that's helpful, then they're wanting it everywhere. And I think they're just trying to stay on top of it.
Yeah, I think the really other thing that's cool in here is, and maybe it's kind of me reading a little bit too far into it, is the pay by bank announcement that they have in here, which I think is really kind of an overall flex, if you ask me, which is, I don't think the card brands are usually as vocal about how much of the network infrastructure that they're actually providing to banks, especially here in the US in terms of money movement. And I definitely think that Visa is going to be on the forefront of launching and streamlining pay by bank features in the future when it comes to like things like whether we'll have a true open banking, and we certainly have a discussion on that coming up. But you know, I think it's really going to be the card networks who are going to be facilitating that connection between banks and merchants and customers. And, you know, one of the things that's potentially going to be different here is, you know, does that mean that in terms of a cost structure where, you know, we've seen open banking in Europe, and in Europe it's quite inexpensive. Does this mean that we'll have still probably a less expensive than a traditional card payment, but will our costs be more elevated for pay by bank? But I think they would solve one of the big issues, which is how would you even start to have a pay by bank network that is multifaceted and can connect a lot of different banks to one service?
True, and I think that actually the networks, and in particular Visa, is a little bit ahead, I'd say, in terms of technologies and innovation here, but Mastercard is closely following. I think they're becoming, again, the network of networks, so they are remaining and even increasing the market share that they have, both in terms of payment methods, but also, payment networks, including the pay by bank, but, you know, with the increase of alternative payment methods, which is particularly relevant in Europe, but also, of course, in Asia or Latin America, they are then becoming the credential. So somehow they remain in the value chain, so they remain as a piece of the network. I think it's great in terms of strategy.
Also,
the network of networks. Wow, that's a lofty.
I mean, when you become the universal credential or flexible credential for whatever, this is kind of huge.
Yeah.
Also, did you see how they're planning to allow consumers to have, I guess, more access and visibility into where your own data is being shared? And I saw that it mentions when you're in, you know, within the app, I don't know exactly how it will work, but being able to see where it's been shared and then revoke access, just kind of cool.
You know, I should care more about where my information is being used, but I don't. But I probably would pay more attention if I
don't really. Yeah, you don't really get to see that right now. I mean, or maybe there is ways. I'm not 100% aware, but if they're trying to make it more accessible too, you know, instead of being completely behind the scenes, like, okay, well, here's who's, you know, where this is all being shared to for your, you know, shopping habits or different components like that.
Well, honestly, not a hot take that we put on here before, but I just saw this article come out about PayPal, how PayPal is trying to get into the ad tech business.
Mm-hmm.
Basically selling demographic payments information to people, which is kind of wild. And
well, you know, our phones are all listening to us because as soon as I start talking about something, the next day I get an ad for it.
Well, and really, like, I mean, obviously, ad tech is quite different in North America than it is in Europe. And I definitely, you know, could see PayPal having a big jump in ad tech in Europe where, you know, the cookie apocalypse happened. So, you know, where else are you going to be able to get that data but from PSP? But I think there's probably more. We should dive into that at a later time, but because I think there's a lot to talk about there.
I agree. I would love that topic. Let's keep that for our next podcast. Yeah,
we got to save something, people. We've got a lot to talk about already. Obviously, we talk way too much. All right, TokenEx and IXOPAY, and it is pronounced IXOPAY for those who are not European inclined. I would have called it IXOPAY or something like that, but Shira and Gab make sure to keep me honest on it being IXO.
Exactly that.
Yeah, they're a German-speaking company. They're, if I'm not mistaken, based in Austria. So yeah, could be the reason.
And Chelsea and I, we go way back with TokenX, which is an American company, and how we remember TokenX being used in the past. And I think it makes so much sense that this merger is happening, which is TokenX was always, to me, a third-party token provider, right? They would solve the problem of, I want to use this application. It's my application or it's somebody else's. I want my data to be tokenized, but I don't want to be forced into a specific acquirer relationship because I don't want my data to be tokenized under those services. And so IXO being a payment orchestrator, this just makes perfect sense to me. Gabshira, I mean, obviously you guys are in the land of IXOPAY. I think most of us Americans have never heard of IXOPAY all that much.
Yeah, I would probably let Shira elaborate on that. But basically, we've been working with a client, and in the middle of the project, we had so IXOPAY as part of the participants that we were talking to, and at the same time, some of the teams were talking to TokenEx. So that, from one day to another, we found out that they merged, and that was huge because it became the same company. So,
Yeah,
very concrete example of how relevant this merge is.
Yeah, it's all the more relevant as, especially in Europe, the orchestration, of course, we heard about it. I mean, we've been hearing about it for a few years now, and it's as though, at least in France, it's as though big companies, French companies, no matter whether they are French or European companies, are, implementing a payment orchestration layer. So what is important to have in mind is that maybe it's something that it's everybody knows what is a payment orchestrator, but a payment orchestrator is a kind of technical layer that is between the merchant and the different payment provider that the merchant can pretty have, and that is specialized on orchestrating, payments, but especially card not present payments. The thing is that with these, what we see, because we see that, of course, TokenEx is a third party. He's well known for being a kind of third party tokenizer. But
don't gender TokenEx.
Sorry?
I said don't gender TokenEx.
Oh, sorry. Sorry for my English speaking. So there may be maybe a third-party tokenizer, but IXOPAY, in a way, does. I mean, we know them a little bit. We know about the services that they provide, and they also provide an internal tokenization. So any merchant can also use, for instance, IXOPAY as a third-party, in a kind of a third-party tokenizer. So this is a very, very interesting merge that we are, attending, that we are seeing here. And no matter whether it's for TokenEx or IXOPAY, I think that this can bring a lot of value, even in the payment ecosystem by itself. Of course, the payment orchestrators in Europe, this is a very competitive field, but I think that this will also help other orchestrators to go further on the kind of evolutions that they can make, for instance, and especially, for instance, for the card present transaction, because this is a dedicated thing that some merchants are looking. They are looking for omnicanality, of course, for omnichannel experience and all that, but they are also looking for orchestrating also card present transactions. So this may be a way to come at the end at a good solution, a robust and parent solutions.
Yeah, I mean, I think if you look at the role of payment orchestrators, and I do think it's a very big up and coming service that I think not a lot of people pay as much attention to as they should, but it's like the eternal problem of omni-channel. I want, Acquire A is the best subscription, manager. They have all the bells and whistles. So I want them to manage my subscription service. Okay, but Acquire B is the best for, say, like my hardware sales or, my direct agent sales channels that integrates into my ERP. And then, okay, Acquire C actually is going to give me the best price for my retail locations. And, they have a better point of sale system, and I want to use that point of sale system. In the traditional way, right, you would have to have those three independent relationships, or you may potentially have to sacrifice getting the best in all three, territories to pick one acquirer who could cover them all, because ultimately, at the end of the day, you're trying to limit the amount of effort your IT team has to put in. You want omni-channel, so you want to be able to exchange a token across all of those different channels. And this is really what payment orchestrators solve, is they say, I become the single point of integration between you, the merchant, and what you need, and then I handle all of the downstream integrations. And so the merchant is really only establishing one link, and everything else is handled by the orchestrator. And I think that's what TokenEx is going to bring to the table, which is the fact that they obviously have so many other certifications that they've already created, in the sense that they have always been a third-party token provider.
Yeah.
Agree, disagree with my assessment of payment orchestration?
Yeah, totally. But, you mentioned omni-channel, and what we are used to hearing from merchants. Sometimes we should be careful about what we call omni-channel experience also, because sometimes merchants are looking for omni-channel absolutely. And we realize that it's not even necessary, So, of course, orchestrators are good players to have, especially when you have, as you mentioned, Dan, several providers to manage and several, things to do with several things and several ways to do the things, and that it help you rationalize a little bit by bringing you also more flexibility in terms of third-party connections. So this is something good, but we should be careful about, is it really necessary for me or not as a merchant?
Good point. I think I definitely always have that conversation as well, which is, how much of this do you really actually need? Because I'll say that while, yes, it solves those problems, the other problem that it doesn't solve is merchants overbuying technology and overbuying, which is, do you actually need all of that? How big and how important is that in your strategy today? Can you demonstrate that you already have a bunch of customers trying to move in between these channels? Or what are you trying to accomplish in terms of your goals, and how is that achievable? And, is this really the best possible way for you to move forward, right? It might not be, but I think that's, all things that have to be considered in the eternal overbuy or underbuy situation. Where's the Goldilocks zone?
I agree completely, yeah. You're totally right. And also I don't want to give names, we are not here to drop names, but, we attended also an era where we had more and more, end-to-end payment providers. And the thing is that some of them may be reluctant to establish connections, for instance, with third-party providers, no matter whether it's a third-party tokenizer or no matter whether it's a payment orchestrator, for instance. And these payment provider, we are attending to something very interesting, is that these payment provider who were used to saying that they will never connect, to, and they will never allow a third party connection. They are changing, it a little bit, and they are, considering the fact to be able to open the different channels that they have to a third party connection. So this is really interesting also to see.
Would you say they're Gen 3 acquirers making those types of comments, or Gen 1?
I would rather say Gen 3.
Ooh, okay.
The one who, if we keep the same kind of definition.
The level of anonymity within what we mean by Gen 1, Gen 2, and Gen 3, totally, we're not saying names. And if you don't know what we're talking about when it comes to the classification of Gen 1 or Gen 2 or Gen 3 acquirers, listen to one of our episodes. We definitely had a rousing discussion on who gets to call themselves what. So if you don't know what we're talking about, go back and listen to that episode, because I thought we had quite the fun time talking about that.
Definitely, yes.
So let's talk about my other favorite topic, which is U.S. regulation when it comes to debit cards.
Mm-hmm.
So, of course, there seems to be now more than ever a lot of discussion in U.S. regulations about our card payments, and eternally one that comes up over and over and over again is the Durbin Amendment. Whether it went far enough in its original iteration or whether there is still room to go in terms of further reductions. But now I think this latest article that we've seen talking about it now presents a kind of other side that we've not seen before. And I think, Chelsea, Jasmine, and I, we all lived through the original iteration of Durbin. And we always knew that there was going to be pushback, right? I think famously a bank, in reaction to Durbin, tried to start charging their customers like a $5 a month fee for having a debit card, to which they quickly removed. But, banks have continued to post record profits after Durbin anyway, and so it's hard to say whether they are actually having any issues with revenue. But I think the big thing that we've seen now is that will Durbin evolve to where, at least in its current iteration, will that debit card fee cap be moved from its current position at 10 billion in assets to banks with only 50 billion in assets? Kind of wild, because those are some very large banks in the 50 billion territory. But that would really mean that a whole bunch of institutions that previously were covered and had the exempt or had the non-exempt rates would now be able to collect the full debit interchange.
Yeah, so we're just going to see significant increases to the merchants,
Yeah, and my 2 cents is one of the reasons why I think that this could potentially actually get further than anything has ever gotten before is we have seen some smaller regional bank failures, right? It's been discussed that we should all anticipate that there will be more bank failures around that size. and also just the interest rate environment as well. So, and the kind of monetary tightening that could potentially have could be a reason for bipartisan support on lifting that rule from
Russia.
Yeah.
I think one of the common themes between these legislations and acts they're working on changing is you see this reoccurring mention of the consumer and the consumer seeing, a decrease in price at the retail locations. But, it's really, they're not going to achieve that by increasing the, bank size who has to follow the Durbin Amendment. Just because a bank gets to assess more doesn't mean the consumer is going to benefit from lower cost or better banking. Because there's actually no stipulations being put in place that any of that where they think there may be savings has to be passed to the consumer, right?
Totally. I mean, it's not like we're going to have a brand new debit interchange rates that are less than what they are now, right? For the exempt rates. So it's like, it's not like those savings are going to be passed on. And, in terms of the kind of claims that this additional revenue stream will allow those smaller banks to innovate, I think that's questionable.
I do too. And they'll have a better offering. I'm like, no, I do not feel strongly on that. I think the consumer will not benefit. Or it would be less.
And I also think that, again, these kind of scare tactics of, well, banks are just going to have to start charging people more to bank. I'm like, I disagree. I think you earn enough money as it is. And that's where like the other side of this story sits, which is, well, instead of 5 basis points and 22 cents, maybe it should be around 14 cents and 4 basis points instead. And I'm like,
but we're going to let, 2,000 banks out of the Durbin Amendment now.
Yeah, I mean, I'm on the side that, keep it at 10 billion. And I think it should get pushed down from 22 cents to 14 cents, because one of the things that we saw living through the Durbin Amendment, which was there is a small ticket rate and there is a small ticket debit rate. And when a bank was regulated and therefore had to pass the regulated interchange, the regulated interchange rate ended up costing a small ticket merchant more than the older small ticket rate. And I think this is where, hey, if you're listening, Dick Durbin, maybe you should have called us and we could explain to you exactly what these things mean in terms of different merchant classes, because your small ticket merchants get crushed by this. And you should have put in a provision that said it has to be the lower interchange rate, regardless if you're regulated or not. If the ticket size demands that the standard small ticket rate results in a lower fee, it should default to that and not the regulated rate. And I think if someone was smart enough to have thought through that, then maybe we wouldn't even be having this conversation of what costs more or what costs less.
Mm-hmm.
Call us. Our numbers and contact information are easily findable. We're happy to discuss. And I think following closely on that topic, right, I think the next one is, related to the CFPB. And the CFPB, or wait, is it CPFB? Consumer Protection Finance Bureau, CPFB, is stepping up enforcement on what are considered non-bank financial institutions. and these are like really your PayPals of the world, your payment processors, all of the fintechs who are kind of getting into the bank territory. And, obviously the biggest kind of magnets for non-bank discussion are like your buy now, pay later companies. And the fact that, hey, a lot of the regulations as it exists today don't cover these companies. They don't have the same liability that a bank has. And so there's a big discussion on whether they need to be regulated as if they are a bank, or at least a different set of rules, because they are such a huge part of the finance world and payments world today. And they intersect with consumers in a way that we've never really seen before. So I again caution. I think it's right that some people are cautioning that it might not go the right direction. But this is where, if you're in the CFPB and you want more information about how these products actually intersect across consumer segments and how actually to protect people in a meaningful way, I think one, don't listen to banks. But two, you have to maybe listen to people who interact in this space a little bit more to see what are the types of proper protections that would be beneficial for consumers in this space, and better informed regulations, rather than imposing a regulation that may or may not be effective.
Right. Just kind of taking a blanket approach when there's probably a lot of nuances that need to be considered.
And, guys, I think the European, as usual, European regulations, Europe loves regulation. I think we started to regulate those people in Europe, but, a while ago, and most of them became what is called today electronic money institutions, some others payment institutions, but they're actually regulated in Europe. And the way it works, and I think would be interesting to see, as a best part, probably for this institution in the US, is basically that there is a list of licenses, and you apply for one or many of them. And at some point, there is a difference between banks and those institutions. And this is pretty much based on the capacity and the capacity, to provide credit. This is, as of today, the main difference between a PayPal in Europe and the bank. Basically the credit, but everything else, including the controls, are pretty much the same, but also depending on the risk of those companies.
Yeah, very interesting to look at, and I mean, it's not to say that like there is no regulations on these people, but I think in considering the financial services that they're starting to provide, I think that's where the I was right, it is CFPB. Great. Watch me. I'm giving everybody dyslexia. It's hard to remember all the acronyms in our world. I think that's where they're starting to lean into of like, hey, you're getting a little bit too much into the financial services sector, but you're not regulated as if you are. And our last hot take before we get into our main section is, again, probably one of my favorite topics, which is open banking, which doesn't really exist in the US. But we're trying.
Does it even exist in Europe, if we are really honest?
It hardly works, in a proper way. And
I mean, that is true, right? I think we know who the open banking players are, etc. And we've definitely looked at them before. But it is often striking to me that it is not as widely accepted as you would think it would be.
That's it, exactly. And there were some studies around the payment, the acceptance rate, which was not that good for this kind of transaction, for open banking transactions. So few things, it was considered as a revolution, before being implemented. And several years after, going live, the results are not that high. And what we can see is that even merchants regarding that are not really eager, to implement this type of solution, even if it's supposed to be lower in terms of costs than a credit card, for example. But it's quite difficult, it's struggling a lot.
And I also don't think it's very popular either, because the risk of it is very, very high. So that is another reason why it's not so popular. You see it all, even in this article, the risk is very, very, it states that this particular open banking is high. I see why it's not popular.
Well, it's definitely among a class of financial institutions that definitely have some fear of it. And I mean, I was just in Europe, much to Gab and Shira's excitement, and bopping around where Europe, where payments is supposed to be so much further ahead than the US. And I have to say that at least in a lot of the retail experiences that I was in, I was like, I don't really see that much of a difference between what we're doing here versus over there. I would say maybe you guys offer more tap to pay. That's nice. Not as always as common over here, but we're catching up on that. But getting to this open banking discussion, I think, and I was just in a webinar the other day talking about fraud. And I think that's really where everyone is just kind of concerned is, if open banking becomes more popular and the speed at which those payments move becomes faster, banks of a certain size have to beef up in terms of identity verification, having to make sure that the person accessing open banking is in fact the correct person, because the speed at which you can move the money and do those transactions and the risk of what that person could have access to once a fraudster gets into that system, it can move very, very fast. Which I think is what we talked about with in a few episodes ago when we talked about like instant payments and some of the risks, right? Which is the money moves fast and fraudsters move fast. So the faster you can move money away from something and the more instantaneous it moves, actually like the greater risk of a fraudster can do a lot of damage in a short amount of time, because what is the finality of that, and what is the process of pulling those payments back once they're out? So I could definitely see why, especially these kind of middle of the road institutions have a lot of fear of participating in an open banking network.
Yeah, and also talking from the European experience, so open banking is a protocol, is something that you can, that facilitates the way you process this type of payment, but it's more a way to pay rather than a payment method itself. And we are seeing that because there is a quite significant increase of local payment methods in Europe that are based on some sort of open banking at a local level that work really well. But the difference with open banking is they are owned by a company that is making money out of it. And I think this is probably the lack of open banking so far in Europe, and the reason why there is Wero, which is the new sort of big European payment method based on open banking, that we make money out of open banking. I think that's probably one of the key questions is, the business model behind and the way you share the money and the profitability across all the chain. Otherwise, there is no incentive and there is no interest either to protect from risk, because risk is expensive, right? So I think it's a lot about generating money for all the participants. So we get linking to the first article that we discussed today. Could become the owner of?
Yes.
Okay. I don't.
You totally stole my thunder on circling back to the beginning of being like, this is the network of the networks, right? Like, and this is probably why they're so successful at staying around is they're like, oh, you guys want this? All of these banks can't get their acts together. We'll come in because we're so used to being able to provide all of these security services. We have the experience in moving money in this capacity. We'll become the fabric for open banking for these banks. And then, they have their hand in it. And there you go. That's how everything circles back. So I know we talked about our good friend, Dick Durbin, and he's, always pursuing something in terms of credit cards, payments, etc. So now we have the proposed Credit Card Competition Act, right? This is being championed by Senators Marshall and Senators Durbin, which is, we are all used to there being the requirement to route transactions over multiple debit networks and having those networks be unaffiliated. But should we add credit card networks into the mix? And I believe that there is this thought that having multi-credit card network routing ability will lower costs. And I guess I'm just sitting there scratching my head being like, lower costs for who?
Right.
I mean, I don't think I'm speaking out of turn, but there's 4 global card networks: Visa, MasterCard, Discover, American Express. One of them is notoriously the most expensive. So, like, what? Are you going to have a credit card that can route to Visa and American Express? Well, it's never going to route to American Express. Like, is this going to be something that actually advantages Discover? Right? So now you have Visa and Discover cards, or you have a bank can issue a card that does Visa, MasterCard, and Discover. I mean, I think we had this, did we talk about it last week? Not last week, last month. Which is, when we look at what are the current interchange rates today, right? For a lot of, and this I feel like is contested by a lot of merchants in the US, they're basically the same across the card networks. You're not getting a big 25 basis point delta or 40 basis point delta for the same type of card product between card networks. You're maybe getting 1 or 2 basis point delta.
I think one thing. No, go ahead, Shira.
No, sorry. I just want to, it's true that while looking at the difference, there are not as much difference at that. And sometimes we even see, some of the schemes, aligning on the most expensive schemes. So
allegedly aligning.
Yeah, so that was just my remark. But please go ahead, Chelsea.
We're going to have to do some ethics training here or some media training to make sure that none of us get sued. Allegedly aligning.
I mean, the one thing they mention in there's, a number of articles about this is how it will lower interchange fees, which again, they're saying will drive down the cost And in turn, consumers will see savings, which I think we all probably question slightly. Additionally, they mention the interchange component throughout all of their articles, but they don't really dive into all the fees or how all the fees are working, right? And what fees are going here, which fees go to the bank. They just continue to mention interchange, and that makes me curious. When this was drafted, who's coming up with this, right? They don't. Do they have somebody who used to work for a card brand in there explaining how all this works, or is this just, and I find it interesting and kind of confusing.
I know, as people who analyze interchange rates between card brands pretty much every single day, it's, this is where we're like, what differences are you guys talking about here?
Yeah. I mean, because a rewards card is going to be a rewards card, right? And they mention that this is going to impact rewards. Well, if someone is using, an Air Miles based card, I'm not sure how just rerouting that, because that's just one component of the fee. There's multiple fees that go into that transaction, and that's what they're not really breaking down. Or
especially across different merchant category codes, etc.
Right.
They can be interpreted differently. And, of course, the bank argument is you force us to lower fees, or if we, interchange fees go down, it means that there's less rewards for cardholders, and that's bad for the system overall. And it's like, I feel like that's questionable, like forcing people to spend more money on credit cards so that they get more points that you tell them how they can use. It's kind of like, getting almost like a monopoly money of sorts, of being like, oh, this is great, you can earn these rewards points, but it's not like rewards points are necessarily cash. And if you cash out points, do you get a dollar for dollar, cash out when it comes to points? I don't know. This is me not being a heavy credit card user is maybe not my insight maybe isn't the best here, but I just don't feel like usually points are as freely usable as cash.
No, definitely.
And then, so from a legislation standpoint, you do that, well, then maybe you then have to tell banks, well, your points are as good as cash. But then I think about, how does this actually even work, right? So there are different networks, there's different routing, there's even different specifications around like authorization message formatting, etc. So now how does the ecosystem respond to having one PAN that's potentially usable across multiple networks? That would create so much friction in the way that routing is done today, right? So much of routing happens off of that bin. And that bin, that first digit of the bin tells you the card brand. So now that would not even be able to be used anymore, because it'd be like, okay, a 4 usually means it's a Visa card, but now a 4 could mean a Visa and an Amex, or a Visa and a Discover. And if bank changes alliances somewhere down the line, do they have to reissue the card? I think you would also see a proliferation, if again this is even feasible from an industry perspective. You know what I think you would see? I think you would see credit smart routing fees start popping up. You would see an entire new service come up that's like, okay, do you want to control the credit routing responsibility, or do you want us, the PSP, to control it? who ultimately gets to control how the transaction routes. Made all the more difficult if there's a single Visa flexible credential.
Maybe you would have a third party, but at the network levels, But,
I mean, I think it's an interesting idea, right? But I think, again, it's one of those things where, and I'm not trying to white knight for the industry here, right? Like, I think it's too expensive as it is. But I also just think that, like, even in a world where this passed, it would take years for the industry to be able to support this.
Exactly, yeah. And no matter what kind of provider or payment, actor in the payment ecosystem, it will be, it would take time for everybody.
Or they're not putting in any, levels of caps, right? Or requirements in terms of price. They're just saying by opening up this to, they think,
multiple networks that they'll magically, reduce fees.
Produce, cost reductions, which,
we think the opposite is true. We'll go, hey, maybe I should increase my cost to match their cost, so now there's no differential. I don't think you would see people coming down the other pathway.
Yeah.
So, I mean, realistically, if we want to do something about the fees of credit cards, you have to put in caps.
There has to be caps and regulate. Yeah, there has to be limits.
I'm not saying we would be as severe as maybe Europe and saying like, hey, 30 basis point cap here on credit. Because, of course, that would just, again, create a huge disruption to the whole rewards market. But I do think it could be very interesting to be like, nothing can go above 2.75%. Like, that is your cap of what is allowed. And I think that probably what you would see then is everyone would just set themselves at the cap. But I just think that this is a good and great discussion of Visa and MasterCard, but also, like, literally, if you're not considering Amex as part of this whole discussion, you are missing 30% of the market in discussion.
Yeah, it's good to remember that also.
Yeah, like, it's great to talk about multiple routing between Visa, MasterCard, or Visa, MasterCard, and Discover, but you have Amex in the mix. And so, unless you want to kick that hornet's nest, I just don't know how successful you're going to be. All right. Well, you know what? I think that's a good place to end it. We talked about a lot of really cool and fun stuff today. Of course, we linked back to several of our other discussions that we've had throughout this podcast. So definitely give all of those episodes a listen. We definitely hope that you like, subscribe, share this podcast with a friend who is a nerd and likes to talk about payments too. And we look forward to our next month's episode.
Thank you. Have a nice day, everyone.
Thank you.
Bye.
Bye, everyone. Thank you.